Hello everyone, Casey here and welcome to the Baking Analyst channel. On this channel, we cover economics, personal finance, and cryptocurrencies with a focus on yield farming for now. However, as you'll be seeing in today's video, we'll be starting to cross over a bit from yield farming into TradFi and looking at how the two strategies may complement each other. So if that sounds interesting to you, please do consider giving this video a like and subscribing to the channel. So today we'll be talking about how I found that writing options and yield farming actually share a lot of different similarities. And this is not so much something to recommend one over the other. It is more of a way to perhaps bring in people from the options writing community or Thetagang into considering yield farming, and people who are in the yield farming community into considering other ways to make use of their assets to generate cash flow. If you're completely new to yield farming and would like to know what exactly it is, I have some other videos that explain it in brief, as well as a DeFi course on Skillshare, which you can access with a free trial at no cost to yourself. I've put the links in the description below. So with that said, let's get started. Firstly, for those of you who don't know what options are, an option is a contract that allows someone to buy or sell shares at a given price. So for example, if I were to sell a put option on Apple stock for say $147 on the exchange, I would essentially be selling someone else, whoever who buys that option somewhere else in the world, the right to sell me 100 shares of Apple for $147. Now, of course, if the price of the Apple stock is trading above $147, no one would do that because it just doesn't make sense to take a loss to exercise that option. However, these contracts are generally used to hedge because let's say if the stock falls below $147, then it makes sense for the buyer of the option to unload that stock onto the seller of the option for a price that is higher than the market rate. How does this play into generating cash flow on assets? Well, cash flow can be generated on, let's say, cash or 100 shares that you already own by writing options. So with those of you unfamiliar with the options community or Thetagang, there's actually an entire community on Reddit, our Thetagang, that is dedicated to discussing strategies on selling options. So writing options. Writing options involves selling someone a contract to buy or sell 100 shares at a specific or strike price. And then in return for taking that risk of getting assigned the stock or having your stocks called away, you collect cash as a premium. So this cash can be thought of as yield or analogous to the farm tokens that we get while yield farming. The thing about options is that they can be secured or covered by either cash. So if you don't already have the stock, you can sell a cash secured put, meaning that you set aside enough cash to purchase 100 shares at the required strike price, and then you sell a put option. Or you could sell a covered call, which means that you already have 100 shares on hand, but are selling someone the right to buy them away from you at a given price. In return, again, you get cash as cash flow, and therefore you may be able to enhance your returns in the event that these options that you sell expire worthless to the buyer. So perhaps to illustrate how options can generate cash flow, it might be useful to take a look at an illustrated strategy, a popular one known as the wheel. So if you would like to know more about the wheel strategy, there are plenty of videos on YouTube by dedicated options YouTubers that will probably go more in depth. But in essence, what you do is you start with cash. You start by depositing enough cash to purchase 100 shares at the chosen strike price. And then you sell a cash secured put at that strike price. And then in doing so, you collect some premiums or cash. At the end of the term of the option, or rather when the option expires, if the stock is trading above the strike price, then the option expires worthless and you keep all the premium, as well as all your cash. Nothing happens to that. However, if the stock is below the strike price at expiry, then you get assigned, or basically you have to buy 100 shares using the cash that you have used as collateral at the particular strike price, even if the price of the stock is lower than the strike. So the wheel strategy works in a way that if you're actually assigned the stock, you then put it in reverse and you start writing covered calls, which is basically selling someone the right to purchase the shares that you now own or have been assigned to from you at a given strike price, and then again collect cash flow possibly every week if you're trading weeklies. So the main point of this video is really to talk about the similarities and differences between writing options and yield farming, and possibly to find some common ground between the Thetagang as well as the Degen yield farmers, and possibly bring people from either side into the other respective investment. So first, let's talk about some similarities between writing options and yield farming. When we talk about the first similarity between writing options or covered options and yield farming is that both involve using assets as a means to obtain cash flow. So when you're writing covered options or cash secured puts or a covered call, you collect the premium in cash, and it is secured by an underlying asset or cash. However, of course, you could always write a naked call and naked puts. It's more risky and uses margin. But yeah, we'll be only covering covered options as this is the most similar to yield farming. On the other hand, yield farming, as we all know it, we collect yield in farm tokens, or let's say, for example, we go to Uniswap and do some yield farming, we collect the Uni token. If we do farming on SushiSwap, we collect the Sushi token. And this yield is generated by providing a pair of tokens in equal value as a claim to a share of that pool and the pool rewards. Another similarity is that both writing covered options and yield farming or liquidity mining is that both involve providing liquidity in one way or another. The idea of liquidity is really about having sufficient buyers and sellers for a given asset. So in writing covered options, option writers are actually providing liquidity by acting as a willing buyer or seller at a particular strike price. It functions not too differently to a limit order in an exchange. On the other hand, for yield farming, we provide liquidity by agreeing that we will always have these two tokens in a 50-50 ratio, which means that, let's say the price of one goes up, we'll be willing to sell that token and buy more of the weaker one. And furthermore, both writing options and yield farming can involve a very similar mindset. Apart from the fact that we look at assets as a vehicle to generate cash flow, we can see that for both types of investment, we have to be somewhat indifferent between the two assets we're trading between. For example, when we're looking at writing covered options, if we're using a trading strategy that involves assignment, such as the wheel strategy, where one of the steps is actually getting assigned the stock or having to buy those 100 stocks, this typically requires you to be indifferent between the stock and cash, or indifferent between holding them. Otherwise, you would see that a further fall in the stock price from the strike price would be taken as a loss of money. And then for farming, we realize that we need to hold both tokens anyway. So we kind of need to be indifferent between the two tokens to not be so worried about this thing called impermanent loss, or having more of the weaker asset that you don't want and less of the asset that you want to hold, such as Bitcoin. So now that we've established that there are quite a number of similarities between writing options and yield farming, and quite a bit of common ground between the Thetagang and the Degen yield farmers, perhaps we could take a look at the advantages of each. A disclaimer here is that I do both writing options and yield farming. I'm not advocating one over the other. What we really want to do in this video is to show you some possible considerations that you might want to make if you're choosing to go over to the other side and try out the other investment from where you are. So the first advantage of writing options over yield farming is that there's a lower rug pull risk. This is because options are traded on centralized exchanges through brokerages like Interactive Brokers or TD Ameritrade. These are not likely to run away with your money. I mean, you might get assigned and you might have to purchase the stock at a given price that might be undesirable to you, but it's also unlikely that stocks that are trading on exchanges, or especially if you choose a good stock, a large cap stock, they are really unlikely to fall to zero. Unlike a lot of farm tokens, which could fall to zero if the developer were to pull liquidity and basically make it impossible to swap out of the farm token and sell it for something that's more widely of value. The second advantage of writing options over yield farming is that it is much easier to transfer your fiat into your brokerage. So it's an easier fiat on-ramp, if you may. This is compared to yield farming, where you have to transfer your cash into an exchange, and sometimes if you're not living in a country that has that currency that is supported for direct bank transfers. You may incur either a credit card fee or have to go through TransferWise and transfer your money in through a foreign bank account. So it's basically much more complex when you're trying to on-ramp your fiat into crypto as compared to transferring your fiat into a brokerage. Finally, there are more quantitative tools available for you to evaluate your investment. So one example in options would be the Greeks. So the Greeks are parameters of options contracts that essentially give information about how the options price would change in accordance to changes in prices of the underlying, as well as in accordance to changes in implied volatility. And one example is the delta, which can be used as a proxy to determine the probability that an option would expire in the money. So you could do much more sophisticated quantitative analysis on the decision to enter an options position. For example, by knowing the probability that an option will expire in the money, let's say 80%, you'll be able to calculate the expected value of the trade if you're familiar with this economic concept. Whereas in yield farming, you're not really given so many tools. It's just based on prices moving up and down and keeping a 50-50 ratio. You would have to have a more fundamentalist view on whether or not these two tokens that you're holding are potentially worth anything to come up with a reasonable expected value. Now we want to talk about some advantages of yield farming over writing options. So the first and probably the most important advantage of yield farming over writing options is that there is low or no minimum capital required as compared to options, which requires you to either put up enough cash or enough shares to be equivalent to 100 shares or options contracts. This is, of course, if you are doing a covered strategy. This would not apply if you are doing a naked put or a naked call and therefore won't require collateral. But of course, that will also entail using margin, which comes with its own set of risks that shall not be discussed in this video. Another advantage of yield farming over writing options is that there is worldwide access to 24/7 trading. Some viewers might live in countries that do not have access to, let's say, the most liquid options markets in the world, such as the US markets. And this would be a problem because this means that they wouldn't be able to access these yield opportunities. And for them, well, yield farming is the only thing they could choose. Furthermore, yield farming typically offers higher APYs, but that would depend on the volatility of the stock that you're talking about. Let's just say that yield farming often provides higher APYs or yield. When we look at the initial liquidity mining rewards for SushiSwap, they were over 100% per annum, whereas these would generally be more difficult to find while selling options. And finally, there is no contract expiry. So you won't have to be dealing with options expiry date. For those of you who are not familiar, options expire every Friday if we're writing weeklies. So it means that at the end of every week, you have to check whether you would like to close out your trade, you would let it expire worthless, or whether you want to roll into the next week. However, with yield farming, you can just hold the two tokens and collect your yield in perpetuity. You don't need to, let's say, renew or sell a new contract or, put it into a new farm unless the APY drops too low. So in summary, this video was really meant to bring out the common ground between yield farming and writing options and potentially bringing members of each community into the other. I believe that both these investments are for people with similar mindsets, of course not financial advice, and we should remain open to considering either, whichever side of the fence we're on. So I hope this video has been an interesting one for you and informative as well. And thanks for watching, and I'll see you in the next one.